Hey, people, ladies and gentlemen. So today we're super happy having Chris Tubby here on our pod. Without further ado, this time I will let you, Chris, take the lead right away. First of all, please tell the audience a little bit about yourself and who you are.
Yeah.
Okay, I've been in the industry for just over 50 years. I started in commodities, then I moved across to the
Small
financial
amount of time.
markets. Yeah, absolutely.
Just
Uh,
5 decades.
I know it's crazy, isn't it? It seems like yesterday. And then sort of about 5, 6 years ago, I added crypto as well. And, I was very fortunate because I became a senior trader at the age of 22. I worked for a massive commodity trade house. So I learned about physical trading as well as the futures. And I was in charge of the futures. The thing was when I left college, I was actually going to become an accountant because I love numbers. But then I got a job offer from what was then the London Commodity Exchange, and I thought, oh, I'll just go and give it a go in London, see what it's about. But after 2 days, I just thought, nah, this is what I want to do for the rest of my life. And I have been. I've added different aspects to it because although I still do my trading and everything, I've wanted to try and help others stay safe in the industry as well. Because, you hear such really sad stories about people losing their capital and savings and everything. It's one of the reasons I like to do it.
Chris, I do have a question to start with. When I look at myself, in the future, I don't see myself, I don't realize the situation that I would be able to remain in the industry, in the same industry for 50 years. This is incredible. So looking backwards, what do you
Five
think
decades in the same industry. I mean, this is
in
tough.
its say? Yeah, we know like in our startup, in our company, Alga Space, we are aware of a handful of traders that have been involved with anxiety, went to psychology, went to psychotraumatic treatments, finished a trading session in hospital because of anxiety and because of mental stress and physical stress. Even though I know someone that got a heart attack, and eventually when I hear you guys like you and we had like previous guests that have been involved with the markets for 30 years, 40 years,
Yeah,
41 years,
it's insane.
those are the insane amount of time. And I ask myself, what differentiates you, Chris, and the rest of the guys that have been involved with the same industry for a long time to the others that finished the training session in the hospital?
Well, I think there's a few parts. I mean, one of it is the background and how you're brought into trading. I was very fortunate. I had some good guys to train me and mentor me when I first started in the industry. And after probably about 3 years, I chucked myself in the deep end as well by going to this massive trade house, where I ended up trading coffee. I mean, I used to do up to sort of 30% of the daily volume, and the market was very, very volatile. But I think, I've been trading my own capital for 38 years. And, I only started with a small account. I only had 10K to start with. So I had to grow it over time. So again, I understand, different people at different levels. It's not as if I just worked for a bank and been used to dealing in millions and billions. I understand it from the ground up. But so,
Mhm.
when I'm in positions, you know, when I take a loss, it doesn't, for me, it's just one trade out of 100 or 1,000. So I don't take it personal, which a lot of people do. And the other thing is as well, the way I sort of justify it to myself is that trade can no longer damage my capital. So it's gone. And psychologically, I mean, I've been in the market 50 years, so you sort of you learn to switch off, but you can't switch off everything. When I'm in my trades, I can get remove the ego, no problem, and I can remove hope, which I think is very dangerous in trading. It's great in life, but not so much in trading for sure. But the ones that you can't get rid of are the fear and the greed. And, I had to sort of adapt and change my style of trading to sort of pacify both of them. So the market's moving in my favor, and I've got fear saying, take the profits, take the profits, and the other half of my head's going, not yet, not yet. And you got that battle going on in your head between fear and greed. So I developed sort of my own sort of style of trading to sort of try and keep them both happy
But
over per
That,
but
trade.
how did you change?
Well, one of the things I always tell guys when you're going into trading is that probably about 85% of your positions will go against you before they go for you, if they're going to go for you. So what I did was I started to sort of break
And
my
most
orders
likely they
down.
won't, right?
I'm sorry?
Most likely they won't, right?
Yeah. But well, most it just does. I mean, it's
Depends.
just a matter of whether the market turns. So, I use my fundamentals, but I also use technicals as well. So, I've identified where I believe the market's going to be rejected. It doesn't always work that way, and I do get stopped out at times, obviously. But it's so the way I sort of construct my trades is I work out where I believe the market's going to be rejected, and then I break my position into three orders. So I get in a little bit earlier on some, and then I get very close to, say, a support line with the final, and then I take the mid price. So I'll just have three orders in there. So rather
I
than
would like
going all in at one price, so I'm just trying to get a nice average, basically.
I would like to go deeper with what you have described right now. So every time you go onto a trade, you divide the trade to three different levels, right?
Yeah.
And each level, you have like a certain amount of capital that you enter each and every single time the price goes towards its trend line. Like, so hypothetically speaking, if there is a strong resistance area, like let's describe it really easily for the audience to understand. So if there is this a significant resistance area, so like you plan a three level, and each level you put a certain time, a certain capital within the position. So first of all, how do you plan the levels? Second, how do you manage your risk? And third, and I think that's a question that will influence the entire decision making process is how much money do you insert in each level?
Yeah, so the first thing I do is I do my analysis. I identify where, let's say there's a resistance level at 80. So I've got my resistance level at 80, and then I just work out how far in front of that I'm prepared to start selling.
Great. So
Uh,
I'm sorry for the interruption, but let's just give an hypothetical example on a certain asset. Which
yeah,
asset
okay, oil.
do you
Let's
much
take
prefer
oil.
to? Oil. Yeah, sounds great.
Yep.
Let's go.
So
All right.
I've got a resistance level at 80. So I work out how far in front of that I'm prepared to start my selling. So let's say I start at 74. So I'll have an order
Mhm.
to sell at 74, another order at 76, another order at 78. And then there's the resistance at 80, and I'll have a stop above. So again, the stop is going to be based
You're
on
not moving the
twofold.
stop towards.
I'm
You're
sorry.
not moving the stop towards the take profit level.
Well, my stop loss is going to be based on two things. It's going to be how much I'm prepared to lose in that trade. And
Uh-huh.
then once I've worked out how far away my stop loss is going to be, then that helps me with my position size in overall because it tells me how many contracts I can sell, and then I've got to break that into the three levels. Uh, Now there's two ways I can do that. I can break it into three, and then I can actually have three stop losses above, or I can just take the average of the three sales and just have one stop loss above. I
Yeah.
always think I play a lot of chess, so I always think sometimes, my first stop loss, if I break it into three, might be fairly tight, but it does give my last stop loss a little bit more room. And
Got
then
it.
because once I've identified, how many pips, ticks, or points I'm going to lose on that if I'm wrong, then I work out how much of my capital I'm prepared to invest in that trade. You know, how high a
Yeah, makes
probability
sense.
trade is it? And then once I've done that, that gives me my position sizing. You know, I like to
Hmm.
deal in zones rather than a specific price.
I got it. And well, that was a great insight. I would like to highlight it. And I would like to ask you, you have mentioned that for example, you're going to trade the oil, the oil instrument. Now, me and you, we know how volatile the instrument is. So back then in 2020, the people paid you for getting a bucket of oil, and right now the oil price is rising towards like
WTI
um,
is about sort of $78, $79 at
yeah.
the moment.
So, how do you, yeah, how do you trade volatile instruments? How do you look at volatile
Carefully is
instruments?
the answer, but
Yeah, of
you
course,
know,
but
it's
it's
again for
complicated. Let's face
volatility.
it,
But
it's complicated.
yeah,
Newbies can't enter the market. I don't think it's going to be a wise suggestion
yeah,
from
you've got to be
anyone
very
to
cautious
let
and
them.
keep your size very small, especially, you know, if you're less experienced. I mean, I used to be a market maker for both the oil exchanges, so I think I know the industry quite well. And
Yeah, you are.
I
Yeah.
mentor customers that are in the energy and oil sectors as well.
So how helpful is that? Like if you're looking fundamentally on how the oil moves, knowing French from the oil industry and from the energy industry, how helpful it was in your trading in your trading the oil.
Yeah, I mean, it's useful. It does help you perhaps understand what's going on in the physical market and fundamentally a little bit deeper. Although I don't like to get too deep. For me, I just, in my head, I sort of pretty much, oil tends to range, but those ranges will adjust over time. And then,
Uh-huh.
um, you know, I mean, if you look at it, I mean, oil's been down last week. It sort of touched just below $66, closed about $69 something. But it's been up in the 80s. I mean, if you look when Russia first invaded Ukraine, it went up to over $130 again. And you know, you brought up a point about people paying you to take a barrel of oil. Well, yeah, because I mean, in 2020, I mean, the market went, WTI went discounted for the first time in its history. It went down to almost negative $40. But again, you know, that was the perfect storm because the Saudis, instead of cutting oil production, actually increased oil production. At the same time, COVID hit, so there was demand destruction. So it was the perfect storm of actually a whole massive supply, but without any demand. And that's really what caused that. The biggest case why it went negative was because there
Yeah,
wasn't
but
anywhere left to
it was a
store
rare
it.
situation.
Yeah, there
It
just
was a
wasn't
rare
anywhere to
situation, the
store the
COVID.
oil. Otherwise, it would never have gone negative.
Yeah, well, basically, um, you know what? Let's talk a little bit about futures. If mentioning futures, I would like us to talk a little bit more about futures. I would like to ask you, how do you approach index futures? How do you trade index futures? What do you look at when once you trade index futures? And especially, how do you look at the market
Yeah, so
once you
I mean, you
trade
got to
index
look at what's
futures?
going on in the economy. You know, at the moment, when you're looking, especially at the financial markets, it's very much about what the central banks are doing. So obviously, we've had this massive tightening cycle where they've gone from practically zero up to 5%. And now they're either started or like the Fed this week will start to cut rates. Again, you know, there's different opinions on whether it's going to be 1/4% or 0.5%, and the pace after that. But you know, you need to have that sort of quite strong understanding in my mind of you know how the economy operates because that gives you, and the central banks, because then that gives you the insight into what could happen or when it could happen. And you know, that's always the question is not so much sometimes what's going to happen, it's just a matter of when it's going to happen. Is it going to be soon or is it going to be further down the road? So for me, I've got very strong sort of macro experience anyway. I put on a lot on LinkedIn about, what I expect the Fed or other central banks to do, and even the economy. I'm generally right. And even I've got a daily newspaper that I send out every day, a newsletter. And, I mean, you can go back a year, 2, 3 years on that, and you'll see I'm rarely wrong. It doesn't mean I'm right every time. But most of the time, I think I've got a very good handle on what's going on in the economy.
So I think that's one of your key advantage because yeah, well, first you have been a market maker for how long, by the way?
Market making on and off. I mean, you can even go back to even before the markets were electronic when I was doing market making,
Right,
because I
right.
would do it into product. So before sort of Euribor came in place, which is sort of sort of merging all of the interest rates of all the countries in the EU that adopted the euro. I mean, you had the euro marks for the German, you had the euro lira for the Swiss, etc., etc. And there was a big disparity between those interest rates because German had a solid economy, so their rates were about 2.5%, whereas the Italian economy wasn't as strong, so their rates were about 7.5, 8%. And of
What
course,
year was it?
once they all sort of merged, at sort of when they decided to do that, a couple of years later, I mean, obviously it all became one rate. So I mean, there was a massive opportunity there, and we used to market make the differential between the two different contracts.
Hmm. I got it. By the way, talking about market making, how do you approach market making nowadays, and how do you see market makers intervene with like I don't know, oil trading or another instrument trading?
Yeah, I mean, it's a great question because there's different ways to market make. So a lot of people, a lot of companies, especially sort of like the HFTs, the high frequency ones, they want to really keep their risk low. So they're pretty much arbitraging everything they do. If they sell on one market, they're looking where they can buy to hedge that to protect themselves. And that's sort of their style. When I do it, because I've traded prop for so long, I'm happy just to take those positions on. I was out in Italy for 4 years market making for an Italian bank. And, there I was, I just basically, I was market making the mini contract. So, you've got the full size contracts, mini contracts, and on CME, you can get micro contracts as well. So I was market making the mini. So I was just pricing off of what the full size contract was doing. So the thing with market making is you don't get to choose your positions. They're given to you by other traders. So you've got to know ahead of time when you're going to get hit, if it's a good trade or a bad trade straight away. For example, when I
Mhm.
started market making out there, it was Friday, August the 24th, 2001. So it was just before 9/11. And so I started market making, and of course, the markets went really, really volatile. Now, for me, every morning, because the market became bearish, I would go short as soon
Mhm.
as the bell. So as soon as the market opened, I'd get short. So when people were selling to me, which they were naturally going to do because they was bearish, I was locking in profits rather than taking on long positions that I was then going to have to try and hedge or sell out and take a loss. So it's about sort of your expectations of where the market's going to go and preempting it. So, that you're ahead of it rather than behind it, because otherwise all you're going to be doing is just locking in losses all day.
Yeah.
So there's different ways to handle that.
Yeah, well, of course, and everything about market making and providing liquidity and like making assets practically moving the economy to grow. I think it's an incredible job to participate with. And I would like, recently the Tel Aviv Stock Exchange have, by the way, this is not a promotion. I'm not promoting any asset. This is a disclaimer. I'm not suggesting to invest in any instrument or in any asset. I'm just saying the facts. So recently, the Tel Aviv Stock Exchange have announced that they were going to be opening the ability to trade on index futures. Basically from the Tel Aviv Stock Exchange. And when they promoted the ad, the trading manager there said that, yeah, we have collaborated with a market making company and they will provide the liquidity. And I would like to ask you, as a market maker, and out of your perspective, what is what he means? What do he mean? Like, what do I need to move the market as a market maker? How liquidity is being created, and how participation in new assets like the index futures in the Tel Aviv Stock Exchange will influence the life of the instrument, and how we influence the economy behind the instruments. So, we'll have the ability to get traded each and every single time carefully and better.
Yeah, I mean, the idea of a market maker is to add liquidity so that if traders need to get in or out of a position, you provide a price for that. So a market maker will have a spread between the minimum or the maximum he's allowed to have the prices for the width, and a minimum size that he has to quote as well. And he has to be in X percentage of the day in the market. And then so your pricing, you're providing two-way prices, a bid and an offer all day long, so that other traders can trade against you. Now you might have someone who's buying the offer and someone else who's selling the bid practically at the same time, which is wonderful. But if the market starts to trend because there's some news or just there's a specific sort of direction for the market, you're generally going to find yourself almost on the wrong side of the market. So you've got to have an edge. You've got to have an outlet somewhere to be able to hedge yourself to manage your risk. Otherwise, you're going to just end up with in a bear market, a massive long position where it's going to cost you a fortune, and then the market makers don't really survive that long when that happens. So you've got to, whenever I'm going into a trade, I always assume that I could lose money. So I have to always think about where my exit is, how I can manage my risk in that trade. And that's the first thing I think about, rather than how much money I can make in the trade, because that's just secondary.
All right, and I would like to expand the discussion about let's move out a little bit of market making and liquidity. I think that we'll be back in the continuation of our conversation, and I would like to ask you a little bit about the congruence between retail traders and market makers, because if you're a successful retail trader, you have to get a little bit congruent to how market makers participate in the market. Am I right?
Yeah, it comes back to the same thing. Market makers are just providing two-way prices. It's up to the traders that are trading against them to get the direction right of the market, because that's where they're going to make their money. I mean, we're just adding, when I do it, it's just a matter of adding liquidity. And as I say, just a pricing so that traders have the chance to get into the market, but also to get out of the market.
Um, I get it. And what do you think about successful traders? Because I would like, you know what, let's move out way more than the regular discussion. Besides trading, I want to ask you a little bit about a characteristic of a trader. What do you think specializes a great trader besides a not great trader? And what do you think differentiates between a super awesome trader to like I don't know, a mediocre or an amateur trader?
I think understanding how markets operate, understanding yourself as a person and as a trader. That's one thing about trading. As you're learning, you learn a lot about yourself, your weaknesses and your strengths as you go along. And I see that when I'm training people, you know, some of them are surprised at themselves, good and bad. But I think, you know, for successful traders, they learn confidence is a main thing. Control is another major one. Knowing when you're wrong and knowing when to get out and just, you know, pulling the trigger, pressing that button and taking that loss and then moving on. You never take trading personal. As I say, it's just one trade out of 10, 100 or 1,000. It's got no relevance. You know, maybe it's a loss, but then it comes down to having a strong risk reward. So, you know, if let's just say I'm going to be right only half the time in my trades, as long as I've got a minimum of say 2-to-1 risk reward in my favor. So, you know, if I'm only right half the time, that means that I've still made twice as much as I would have potentially lost.
I got it. You know what?
And
Talking about yeah,
regarding
Ali, go ahead.
regarding education and mentoring, so you've been educating traders for decades. How has the approach to trading education changed over the years? Has it changed in some way?
Yeah, I mean, it's changed a lot, really, because you know, I've been seeing as a senior trader at 22. As guys were joining the company, I was training them up how to trade, but it was more about execution, and giving them some advice because, you know, at some of the companies I was at, we were allowed to have an account that where we was trading the company money, but we were responsible for the P&L of that account. And then it's sort of really about sort of over the years. It wasn't really until the markets went electronic, and then of course that opened up the markets to the whole masses. Before that, it was very much a very closed shop. It was much more difficult to open an account with a broker, and it wasn't so sort of widely available. But once it went electronic, then it is sort of, you know, for example, when I was trading coffee, I could trade coffee, I could trade cocoa, I could trade gold because they were the physical markets I could walk into and trade them. And then later on, I could trade short-term interest rates, some currencies, treasuries, and such like on live. Whereas now I can sit at home and I can trade the world. I've got access to everything. But it's brought in so many millions and millions of more traders into the markets. And, you know, it's a matter of how they enter the markets. You know, personally, for me, I think there should be at least a sort of like a mini test for people before they can open an account, quite honestly, because too many people are just,
Like what?
you know, everyone assumes from the get-go that if they open an account, they're suddenly a trader and they're going to make money, and that couldn't be further from the truth.
But then what they should do before
Well,
it?
obviously have some education. I mean, you know, you think of any career, any industry you go in, there's always some training involved. No one just says, here it is, get on with it. So you just need that guidance. And I'm not saying that because I'm an educator. I just think it is just normal. It's natural. It makes sense. Of course, you get those odd guys, and I must admit I was one of them, that was just a natural. So, you know, I just took to trading immediately. But it's not the same for everybody. And it's understanding. It's a combination of lots of different things, really. And the only way you're going to get them, I mean, you can watch all these YouTubes. There's so many YouTubes about trading out there, which is great, but it can work against you as well. I have people come to me after they've watched like hours upon hours upon hours of YouTubes, and they come and go, Chris, I'm more confused now than when I first started thinking about trading. And it's because different traders have got different styles. And so you're getting some that are conflicting. So it confuses the people that are watching them. You know, what I try and do is just show people what's possible. Yeah, I'm happy to share the way I trade, but, you know, trading is a unique journey for everybody. So the way I trade isn't necessarily going to suit everybody that's coming through my courses, which is why I sort of show them different things that I've learned from other people that trade as well. And then it's up to them to sort of put their character into it, put their risk appetite into it, and adopt the pieces from the different traders that's going to work for them. It's about building a trading plan. You've got to have a solid trading plan, but even just a trading plan is not going to be enough. You've got to have a decent trading strategy to go with it. They go hand in hand.
But how do you build the first one? Like how do you find yourself, and how do you find your trading style when just
It's
starting out?
experimenting. I call it an inner trader. You have to find your inner trader. And finding the right asset class is so important. Finding the right product to trade, that's the real beginning of your journey. That's the really essential part. Just find what you can connect to, find what you can have some success with, but do it all on a demo account. Don't risk your capital until you've proved that you can develop consistency. Again, consistency is so important. And that's the way that I sort of remove a lot of the emotions in trading is, I'm a very consistent trader. So, for me, I just want to try and make money every day. I don't want to sort of go for make a million any day. I just want to make whatever the market will give me every day that I can.
Brilliant. By the way, Chris, what do you think about algo trading? Because, more and more traders move, especially technical traders, move on to algo trading, especially using machine learning algorithms and regression algorithms. So what do you think about all of this issue with algo trading? And what do you think the human sense and the human intuition is way better than algo trading right now?
Yeah, I mean, algos, they sort of started late 90s, in a real basic form, which was in Switzerland, because the Swiss exchange never had open outcry. They never had physical traders. They went immediately into just having an electronic matching system. And then they progressed from there, obviously, with all the other exchanges over the years. Now, I mean, algos probably account for maybe up to 60% of the daily volume. So it's a very high
Mhm.
percentage. Actually, we've just created our own algo. I mean, we deployed it a couple of weeks ago.
How
So
easy, how difficult and how easy, how
it's
difficult
taken
it is
us
to
over
to
18 months to get it
18
to where
months.
it is. Yeah.
What do you think it's such a long process and the duration of like having an algorithm to trade the markets is so long to be able to get above certain market conditions?
Well, it's about really sort of you've got to have an idea, you've got to have a strategy to automate. So it's a matter of what you're going to use. For me, what we've tried to do is sort of take a lot of what I do as a click trader and just automate it basically, so that we can watch more markets at any given time. And of course, it does take time because we wanted to put lots of different parameters in there that we can turn on and off depending on the market conditions and on the product itself. It's not always a case of one size fits all when it comes to trading. So
Yeah, I
I
get
think
it.
algos are useful. It takes a lot of the emotions out of trading because
It
computers
is.
don't care about emotions. They just care about their programming, their parameters, and then they just sort of just get triggered and off they go. Why you get some of these exaggerated moves in the markets at times is because a lot of those algos are momentum following. So when the volatility starts to increase, when the volume starts to increase as well, which is something to take into account, it can trigger the algo, and then that algo will trigger another algo, and then you got that sort of domino effect, and that's why you get those big exaggerated moves when the market has a big move in one direction at times.
Yeah. All right. Sounds good. Now, look, talking back over your career, I would like to ask you a few questions about how you manage yourself in a game of trading, how you approach the day-to-day trading, and how you remain consistent even nowadays.
Well, I mean, you have to adapt to the market conditions. And, as I explained at the beginning, one of the things I like to do is sort of build my positions up. So I've adapted by doing that to sort of compensate for the market moving. Because if you've got a very strong support level, if you wait to hit that exact support level, you could miss the opportunity. Because there's other
Hmm.
traders such as myself going in a bit early, and it just stops it from hitting that. It comes down to that herd factor to a degree. If a technical level is a very strong technical level, whether it's a trend line or whether it's Fibonacci or whether it's pivot points or something, there's going to be a lot of size or a lot of orders in around those types of levels. And the expectation is they hold. Of course, sometimes they don't, especially if the fundamentals start to turn. And of course, once those levels are broken, again, you can have another exaggerated move because that's all the stop losses getting triggered from the technical guys having to get out of those
Hmm.
positions. So,
I got it.
for me, it's always about adapting. And then when I'm taking my profits on a position, I build a zone. I know I want a minimum of 2 to 1. So when the market's moved in my favor, I'll have a small bit of size in to start with. And I'll slowly edge out of, say, 80% of that position, even though that I expect it to go a little bit further. I'm still easing into that. I'm not just going to back off and wait and wait and wait, because if I wait too long, the market can just suddenly turn and I've missed the opportunity. I mean, I can put trailing stops in and do all different things, hard stops, etc. But, I like to be more proactive when I'm taking my profits. And then, as I say, I'll probably get out, say, 80% of that position. And then I'll hold on to that last 20% and I'll go, okay, let's see where this really wants to go. And then I'll just have a stop loss or a trailing stop based on that, but very wide. Sometimes I'll make more on the 20% than what I actually made on the 80%.
I got it. I have a last question before we go. So Chris, right now you teach your own students how to trade the markets. Um, how it's like in having being a much experienced guy to educate people right now. How do you transform the knowledge that you have embraced over the years to more and more people, and you enable them to trade the markets properly.
Yeah, I mean, I've been doing this. I've committed a lot more time to training people for probably about 12, 13 years now. And the way it all started was sort of I'd written down a lot of stuff about trading, and then I wanted to actually learn how to do PowerPoint. And I thought rather than just waste my time juggling around, I'll actually use all this information that I'd put down. And then I sort of broke it down into different PowerPoints, and then suddenly I sort of come to that realization, wow, I can actually turn this into courses and help people. I mean, when we was oil market making, there was about 12 of us doing this. We brought a load of young lads in, but they didn't all succeed. But all we was doing was cloning ourselves, basically. This is what you do: sit down there,
That's
do
not so
this.
much clever.
And it wasn't right for everybody. So I thought to myself, the best thing to do is just allow traders to find themselves, show them what's like available, and let them cherry pick what's right for their character, because that's the important thing. You can't tell someone how to trade, and I can't trade for them. I just have to sort of encourage them, guide them, but let them find themselves as a trader and just help them as much as possible. So it's about guiding, not trying to force your style on someone else. It's not about cloning myself at all. It's
But
about
building
just showing
a
the
unique
different ways
characteristic.
to trade.
Hmm. It's like
Yeah.
about building a unique characteristic and redefining yourself as a trader. I think it's much more powerful than cloning your mentor.
But it's
Um,
got to be
and
structured. When you're teaching somebody to to trade, you've got to go through all the different areas. You know, you've got the risk management, you've got the trading psychology, you've got the trading techniques, all the different products, all the different asset classes, and how the different ways that you can trade them. You know, whether you're going to trade retail CFDs or whether you're going to trade the futures, which then opens up, you can trade forward curves, yield curves, whether you're going to trade options. I mean, you know, when volatility increases, as it has done in the last couple of years, I will trade a lot of options. And I've got quite a unique way of trading options as well. But you know, I've got sort of 1-day workshops where people can just come and fill gaps in their trading, if you like. You know, maybe they need technical analysis or risk management, so they can come and just spend a day with me. And then I'm just launching actually a free 3-day course, which starts beginning of October, so that people can come and have 3 days of training with me, and it's not going to cost them 1 penny. And then obviously I'll move on then to a 1-week intensive course, which really sort of dives in. It is very deep. At the end of the first day, everyone sort of looks a bit shocked. You can see it on their faces. But by the end of the week, everyone's very comfortable using the system, making those trading decisions. And then, of course, I've got my longer courses, which can be 6 months. Again, you know, it depends on how committed people are to becoming a trader, and of course being able to fill it in with what their existing career and all that. You know, one point I'd like to make here is, if you already got a career and you're going into trading, the moment you can make more at trading doesn't mean you should give up your career. And
So
the
what
and
is
the
your
reason for
position?
that is because you go from wanting to make money to needing to make money. And what I would say is, you want at least 1 year of all your expenses covered minimum, and then a bit more for emergencies as well, before you should even consider giving up your day job to become a full-time trader. You know, because if you've got to make the money every day to pay the bills, you're going to go into lower probability trades, because you must get a trade on, because you must make money, because you got the pressure on you. If you want to make money, it's completely different. You know, you've got all your bills covered with your day job, then that gives you that flexibility to wait and be patient and just take on the right trade rather than just any trade.
Absolutely. So, Chris, I would like to thank you for your participants in the trade pod.
It's been an absolute pleasure.
Yeah,
You shared
was a
incredible
pleasure.
insights. Yeah, it is. You shared incredible insights, and we had a pleasure having you here today. So again, I would like to thank you, and we're so happy for the privilege. And yeah,
Thank you
thanks.
for the invitation. And, you know, great that you're really
With
trying to help
pleasure.
traders. It's fantastic.
Yeah.
Great, great.